Hello, welcome. This is Stocks to Watch on BloombergQuint. I'm Agam Vakil. This is where we take you through three stocks which are in the news and take them up with our experts. Today, the stocks that we are discussing, well, we have Titan Company, which has come up with a quarterly update, Maruti Suzuki on production numbers, and the strength behind Bajaj Finance, especially the recent one. And to take us through these stocks, we have Rusmik Oza with us, who heads fundamental research at Kotak Securities. But before I go across to Rasmik, let's start off with the first one, and we have a Titan a company update on the first quarter. Now, the company says it's at 83% of its stores, which have opened right now. All manufacturing facilities have commenced operations. It's also given us some numbers when it comes to the jewelry sales and the watches. So the months of May have not been that great for jewelry and watches, but June has seen a recovery. In fact, jewelry sales stand at 70% when compared to June of 2019. So there has been a pickup there. And as far as watches are concerned, still subdued, only 20% for June 2020 as compared to June 2019. That said, let's open this conversation up. Raspik, good morning and thanks for joining in. Your view on Titan Company, the recovery is on its way. How would you address this one?
Good morning, Agam. I think numbers that are coming out from the company are quite encouraging. In fact, post results somewhere in early June also that indicated that most of the stores were opening. So out of 1,800 stores, I think in early June itself they had some more than 1,400 stores working, and it's very heartening to see that the jewelry business is coming back to normalcy quite fast as compared to expectation. Because in case of Titan, if you see, jewelry is the key thing because in terms of revenue it accounts for almost 80% and almost the entire profit comes from on the EBIT level comes from the jewelry segment because the other businesses are not contributing meaningfully in a big way. Our thesis is that maybe the activity should pick up maybe from Q3 and escalate and go up in Q4 also because this year's this April to May wedding season has completely been a washout, and a lot of this pent up demand will come up in the next wedding season that's in the winter time. So we're expecting very strong numbers coming up in the second half of this fiscal year, and obviously the run rate of next year FY22 will be far better than the pre-COVID FY20 numbers also. So we're expecting that maybe this year is a little soft, but second half to be far better, and then next year to be accelerating and going way beyond FY20 numbers also in a meaningful way. So this is the trajectory we are looking for Titan. And Titan is a company which we cannot look at a PE multiple to value the company because if someone is looking at a PE valuation, then it would look very expensive, very rich. But we do a DCF based valuation in case of Titan because of the visibility and the predictability of the business. Uh, uh, and the fact that Titan, because of its stronger balance sheet, will be able to garner more market share in these kind of situation. The gold prices could also benefit the company to a certain extent in terms of inventory benefits for at least one quarter or so. And then as demand comes to normalcy, then you'll have a normal trajectory of business going forward. So on a DCF basis, we have a target of 12-15, and we're still optimistic on Titan going forward.
Okay. Well, from there on, let's talk about Maruti Suzuki. It's come up with production numbers for the month of June. Production stands at around 50,000 units. This is, of course, much lower than well over 1.1 lakh units in the same month last year. That said, encouraging signs considering production has increased as compared to what we've seen in May. Um, Raspik, we spoke about Maruti last week as well. What are you looking at in terms of Maruti and recovery going ahead?
Agam, somewhere numbers maybe are still below the expectation in the sense for this Q1 we were expecting sales volume to be somewhere around 1,30,000, but it seems it's ending up at with around somewhere around because it did some 57,000 in June and 17,000 in somewhere in May. So if you add up, I think so it's still not going above 75,000 for Q1 somewhere over there. So somewhere numbers are below the run rate which we were looking for, and that's a little a concern. Hopefully, as the activity picks up going forward, volume should pick up. That's our thesis. Two things which will act in favor of Maruti as compared to competition is one, is the industry has around 30% diesel and 70% petrol mix. But in case of Maruti, almost 90 last quarter Q4 they had 93% petrol mix and 7% diesel. Now since petrol and diesel prices are almost at par, I think a lot of demand could shift from diesel vehicles to petrol vehicles, where Maruti benefits a lot. Two is, I think, almost 39-40% of Maruti's volumes come from the rural side as compared to peers, which is very, very less. Because of which deep penetration to rural side, it will benefit as the rural economy picks up. But nonetheless, the only the negative side is that a couple of key metro cities like Chennai, Bangalore, Hyderabad, Mumbai, Delhi, they're still still reeling under COVID influence, which could lead to some bit of deferment of demand even if people want to, because of this rising cases of COVID. They might probably wait out and then look post monsoon to add buy any vehicles. Hopefully, I think for Maruti, maybe post rainy seasons only we'll see quite meaningful demand coming back. We are still a little negative in Maruti because of the valuation side. Uh, Most of the ROEs have been coming down on a consolidated basis because of the huge cash in the balance sheet. So what we do is we normally value the stock on core business at a 23 times forward P multiple, and cash is around 1,375, something like that. If you add up, we are getting a target of somewhere 43, 4,500. So we are still negative in Maruti, mainly because of the rich valuations.
Okay. Well, from there on, we move on to the final one, and that's Bajaj Finance. Of course, we've had the quarterly update day before, and which is why we saw a very sharp up move in Bajaj Finance yesterday. In fact, if you look at the way it's moved from a 52-week low of well below the 1,800 rupee mark, it's up as much as 88% since the low it made in May 2020. That's a very short span of time in which it's made that significant recovery, and it's now at around 30 to 3,300 rupees a share. Rasmik, your view on Bajaj Finance, what would you do with this one at these market levels?
Agam, we have a buy rating on the stock, but now since this sharp run up, the stock is way above the our target price also. But nonetheless, I think our preview of Q1 looks quite encouraging. We were building in around 20% net interest income growth, a 20% jump in operating profits, more than 20%, I think so, and 24% jump in PBT and roughly around 34% jump in PAT. So if these numbers do turn out, I think so it will be quite healthy as compared to the street expectation. Somewhere they in this recent update, they've guided that the number of customers under moratorium have gone down from almost 25-27% to 15.5%, which is quite encouraging. Another key indicator we need to watch out for is the bounce rate. So the number of check bounce rate was around 37% in April. Sorry, we need to watch out how much is that in this end of June. That's one key metrics to look at. In terms of the customer addition, the run rate is still on the lower side. So I think in Q1 they've added around 5 lakh customers, which is roughly one fourth of the normal addition of 20 lakh customers they used to witness before COVID on a quarterly basis. So the number of customer addition still is quite low. The AUM is, I think so, on the YOY basis gone up 9% from 1,28,000 to 1,38,000, which is, I think so, at par with our expectation and the street expectation. So the entire recovery phase has been quite impressive as of now. Hopefully, if things improve on the rural side, the company could probably focus more on that. It seems that they will be able to do quite a good job on the cost cutting side. So cost income ratio could go down substantially for the company, which could help maintain their net interest margins at around 9.8 or 10%. So if they're able to maintain the NIMs, I think so, it will be very encouraging sign, because from a growth perspective, they don't need to be, there is no concern because their capital adequacy ratio is very strong at around, I think so, 24% or above. So, if growth comes back, they'll be able to grow very healthy and very fast. That is not a concern. As of now, the number of moratorium is quite encouraging. Let's wait. I think we can expect some kind of re-rating post Q1 results, and that is what I think so the street is trying to build in the stock price as of now.
Okay. All right, Rasmik, we'll leave it at that. Thank you so much for joining us and taking us through those
Yeah.
stocks during the news.
Thank you.
On that
Thanks.
note, it's a wrap on the segment, but there's lots more lined up. Stay tuned to Bloomberg.